Is the current all-time high market making you nervous? Could bonds be the safety net you're looking for? As we find ourselves in the midst of a market teetering at record heights, it's quite natural for even the most seasoned investors to feel a twinge of unease. This is particularly true for conservative investors who prioritize safety over high-risk ventures. While stocks continue their seemingly unstoppable climb, there's a growing sense of disquiet brewing beneath the surface. Could this be a bubble waiting to burst? While we can't predict future market trends with absolute certainty, we can make informed decisions based on current trends and expert opinions. One such decision could be to consider the potential of bonds, specifically short or intermediate bonds, as a safer alternative. Bonds, particularly those of high quality and intermediate term, are showing promise as a robust safety net. With the market at an all-time high, it might just be the perfect time to trim your stock holdings in favor of bonds. So, if the soaring heights of the stock market have your pulse racing with apprehension, take a deep breath. Let's delve deeper into why bonds could be the answer to your investment worries. In a volatile market, bonds can be your best friend. But why, you may ask? Well, bonds have the potential to be a steady rock in the tumultuous sea of investing. They offer consistent income, often with a lower risk compared to stocks. This makes them an appealing option for those who prefer stability over the rollercoaster ride of the equity market. Now let's talk about the stars of the bond world: intermediate term and high-quality corporate bonds. These bonds are like the golden middle child of investing. They provide a balance between the risk of short-term fluctuations and the potential higher returns of long-term bonds. Intermediate-term bonds typically have maturities between 3 and 10 years, which can be an ideal sweet spot for investors looking for modest risk with a side of attractive returns. And let's not forget about high-quality corporate bonds. These are the bonds issued by companies with a low risk of default. They're like the reliable friend who always pays back a loan on time. Investing in high-quality corporate bonds can offer a higher yield compared to government bonds without significantly increasing the risk. It's like having your cake and eating it too. But the benefits of bonds don't stop at steady income and lower risk. They also play a crucial role in diversifying an investment portfolio. When stocks take a tumble, bonds can often remain stable or even increase in value. This balancing act can help smooth out the bumps in your investment journey and potentially enhance your overall returns. So, let's sum it up. Bonds offer steady income, lower risk, and portfolio diversification. Intermediate term and high-quality corporate bonds stand out as attractive options due to their balance of risk and return. So, when the market gets stormy, remember bonds can be your shelter from the storm. Bonds are not just a safe haven, but they also hold the potential for attractive returns. So next time you're pondering where to invest, give bonds a second thought. They might just be the best friend you didn't know you needed in your portfolio. Now let's hear it from the modern bond king himself, Jeffrey Gundlach, CEO of Doubleline Capital. Gundlach has long been a voice of reason in the financial world, a shrewd observer of market trends and a trusted advisor to investors all over the globe. In his outlook for 2024, Gundlach presents a compelling case for why now might be an opportune time to direct some cash towards short or intermediate bonds, perhaps even shaving off some stock holdings in favor of bonds due to markets at all-time highs. He's particularly keen on intermediate-term, high-quality corporate bonds. Why, you ask? Well, Gundlach argues that bond yields are expected to stay higher for a more extended period and are unlikely to revert to the low levels seen in recent history. The yield on the US 10-year Treasury broke above 4.5% for the first time since 2007. Quite a significant milestone, isn't it? Not just that, but high-quality investment-grade corporates are currently the most attractive option in the credit market. That's right, high quality, not high risk. And for those conservative investors out there, this is music to the ears. Gundlach is of the opinion that the Federal Reserve is nearing the end of its hiking cycle and is unlikely to cut rates before mid-2024. So the theme of higher for longer interest rates remains intact. Now, Gundlach is not just about bonds. He's also about the people who manage these investments. He believes that adding the potential upside of human insight into the mix through active managers selecting the securities can be a wise move. In the end, Gundlach's message is clear. Bonds are not just for those who shy away from risk. They are for those who understand the value of patience, of waiting for the right moment to make a move. As Gundlach suggests, bonds are not just for the faint-hearted, they are for the wise and patient investor. Vanguard, a trusted name in the investment world, echoes similar sentiments. The company, known for its astute market analysis, has a keen perspective on the current financial landscape. Their views on bonds, in particular, are worth noting. According to Vanguard, we are in an era of higher for longer interest rates. Real yields on bonds are at their highest levels in 15 years. This makes them more valuable in terms of total returns to a portfolio. Vanguard expects bond yields to remain high for a prolonged period, unlikely to revert to the low levels we've seen in recent history. In the third quarter, investors adjusted their expectations for interest rates, which led to the Bloomberg Aggregate US Bond Index clocking in a negative return of -3.23%. Intermediate and long-term yields experienced the largest increase, with the yield on the US 10-year Treasury breaking above 4.5% for the first time since 2007. However, Vanguard does not subscribe to the most extreme forecasts in either direction for the future of interest rates. Instead, they believe that factors such as economic numbers and inflation will play a significant role. Moreover, Vanguard anticipates that the Federal Reserve is nearing the end of its hiking cycle and is unlikely to cut rates before mid-2024. They believe that high-quality investment-grade corporates are currently the most attractive option in the credit market, and tax-exempt municipal bonds offer compelling tax-equivalent yields at longer maturities. Their insights suggest that bonds are subject to interest rate, credit, and inflation risk. However, the potential rewards make them an appealing investment, particularly for those willing to take on a bit more risk than holding cash. Vanguard's insights suggest that the higher for longer theme for bonds remains intact. So, if you're a conservative investor looking for a smart move in the current market, it might be time to consider bonds. A potentially good option for an astute investor is to consider a bond ETF focused on the strategies we've just discussed, like Vanguard's Core Bond ETF, VPLS, with a low-cost and actively managed portfolio that gives the human touch that helps evaluate the intricacies of the broad bond market. If you've made it this far, consider giving us a like and subscribe to support our work. We really appreciate it. Back to our suggestion on the bond ETF that could be a good option for you from Vanguard. What sets it apart is its active management, focus on high credit quality, and shorter to intermediate term, like 6-7 years. Skilled managers scan the bond landscape, identifying and capitalizing on attractive opportunities. This ETF aims to provide a balanced intermediate-term bond portfolio with high credit quality, thereby minimizing risk. It's an opportunistic approach, occasionally taking on slightly more risk, but always with the potential for greater rewards, based on thorough research. This isn't your run-of-the-mill index-style investment. It adds a constructive factor or tilt to your portfolio, making it ideal for those comfortable with a smidgen more risk than holding cash. This new ETF could be the perfect way to dip your toes into the bond market, offering a balance of risk and reward. Be sure to see the link in the description and read the prospectus information carefully, and consult your advisor on rebalancing decisions for selling stocks, or shorter-term allocation decisions that help you earn higher total returns on your cash, and that could bring you stability in a market downturn.